Hey everybody, Smart Silver Stacker here. Hope you're doing well. Seems like every day we are getting more and more signs of growing distress among the world's paper silver markets. Right now, the cost to borrow a share and go short the SLV ETF has skyrocketed to record all-time highs. And this is a development that could lead to a short squeeze in this very significant paper derivative of silver. So we're going to talk about why at the end of the day, when the music stops in these markets, the only thing that's going to matter is physical silver bullion. So let's get to it. Buy your gold and silver at SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Okay, so let's start off today with the charts of the metals, and then we'll get into that news surrounding the SLV ETF and how a potential short squeeze may be shaping up in that paper derivative of silver. Starting off today with gold's chart, notably gold rose to a record intraday all-time high today of 28.86. Now it has come down off of those highs and currently is at 28.62, basically flat on the day. Silver, on the other hand, is in the red. And one scenario for silver that I mentioned in a recent video, I pointed out that silver's previous moves higher last year came in a classic Elliott wave formation. And the way that looks is you get this wave up, then an intermediate correction, another wave up and an intermediate correction, and then a final move up to new highs. And then you tend to get this kind of intermediate ABC correction, which we see here. And if this is indeed shaping up to be another classic Elliott wave move higher, then it looks like what we may be embarking on here is the first intermediate correction, which I suspect could take us down to around the $31 level. And there should be some support there, as that was resistance for some time earlier this year. And then we'll move up to new highs and probably get another correction and then go above the $35 or so high that we hit in October of last year. At least that's how I am interpreting this chart. So maybe a little more room to fall for silver, but I don't think it's anything to be too concerned about at this point, especially when you look at this chart. This is the chart of copper, which is up 3% today. And it's really a vigorous breakout from this downtrend that had been in effect since May of last year. So this is a very bullish sign for copper, the price action that we're seeing today. And typically what's good for copper is going to be good for silver, as both metals are significant industrial inputs. Now, one thing you don't want to do if you are stacking gold or silver or even copper bullion is make costly stacking mistakes. If you want to avoid some of the most common costly silver bullion stacking mistakes, make sure you check out this free report that I've put together, the Smart Stacker's Guide to Avoiding Costly Silver Bullion Mistakes. You can get a free copy of this by signing up for my newsletter with the link down in the description. You will receive a PDF copy of this free report in your welcome email, so check that out. Now, let's talk about the soaring cost to borrow shares of the SLV ETF and how this could be a big deal for those who hold short positions in this paper derivative of silver. So Bob Coleman shared this chart earlier this morning. That's how this got on my radar. And what this is a skyrocketing cost to borrow shares of the SLV ETF. This is a fee that shorts have to pay, because the way that shorting a stock works is you borrow the share, you sell it into the market, and then what you're hoping is going to happen is that the price goes down so that you can buy back that share at a lower price and then close out that position by returning the share. And keep in mind, I mean, this is a simplified description of how this works. I'm not a trader, so take all of this with a massive grain of salt. I am just a stacker looking at this information, but I think it is very important for stackers to pay attention to paper silver markets, especially when the cracks are beginning to show, as they appear to be today. Now, later in the day around noon, Chart Exchange shared this chart that shows that the cost to borrow these shares of the SLV ETF has continued to rise, and now this fee is over 16%. Now, I had to do a little research because, again, I'm not a trader. I'm not intimately familiar with how this works, but taking a look at this page over at Interactive Brokers, I think sheds a little light on this. It breaks down their short sale cost, and it says here on their page that two factors contribute to the daily cost/revenues related to short selling of stocks and bonds at Interactive Brokers. The first is the borrowing fee, which, as we just mentioned, has skyrocketed over the past day to record all-time highs. And then also it says the short sale proceeds interest you receive from interactive brokers. And so this cost to borrow, this fee, is not a one-time fee, at least from what I can gather here, that those who want to short a stock pay. This is a daily fee which is calculated and paid on a regular basis. Now also, they have to pay some interest to you. You can see here on this table on any collateral that you put up. So if you've got a US dollar denominated account and you've got $0 to $100,000 in there, they don't pay you anything. And that's a net asset value, by the way. If you've got $100,000 to $1 million, they pay you this rate. If you have $1 million to $3 million, they pay you this rate. And then if you've got $3 million or more, they pay you this rate. So there's sort of a fee and then also interest that you accrue. But with the fee at 16%, you'll notice that that is far in excess of the highest interest rate they pay. And so what this means is that these daily fees could begin to get very expensive for anyone holding a concentrated short position in the SLV. And again, take this all with a grain of salt. This is just what I'm gathering, taking a look at what Interactive Brokers tells us on their website. But what that means is that if the fees start to add up and short positions in the SLV have to be sold as a result of that, or closed out rather, in order to close out those short positions, these traders would actually need to go into the market and buy back shares of the SLV, and that could put significant upward pressure on this instrument. And the way this can turn into a short squeeze is if the fees continue to rise and these traders have to go and buy back shares, and then that drives the price of the SLV up, then that can force other traders to close out their short positions, and they have to go into the market and bid up the price. And you can see how this can become a vicious cycle. Now, why are the rates spiking in the first place? I think that's an important question. And all I can really do is speculate as to the reasons for this sudden spike in the cost to borrow shares of the SLV ETF. But I am aware that retail investors who buy these instruments like the GLD and the SLV ETF have been redeeming shares recently, meaning there are outflows from these funds. Retail investors have been dumping their gold and silver positions. You can also see this in the physical market with the very low premiums on certain bullion products that we see at the moment. It's because retail investors are selling. So if retail investors are selling their shares of the SLV ETF, there may be fewer shares outstanding, which means there are a shortage shares to borrow, and that could be why the rates are spiking. But nonetheless, it doesn't really matter why they're spiking. If these spiking rates force short positions to cover those positions, it could lead to a short squeeze. So that is, I think, very important. Now, that doesn't mean that the price of silver is going to skyrocket. In fact, if a short squeeze does happen in the SLV ETF, I'm sure there's some way they can weasel out of it. They can probably halt the market. There's probably something in the prospectus that allows them to control this if necessary. I mean, that's what we saw with the nickel market when there was a squeeze there a couple of years ago. They just halted the market. But the reason that matters for stackers is that they can't do that without some consequences. And if, one of the biggest paper derivatives of silver that retail investors have exposure to, if investors lose confidence in it due to the fact that it is halted and the manipulation is exposed, then you can start to see cracks really show in paper silver markets across the board. And at that point, well, that means maybe the end of silver price suppression. And at that point, the stackers are going to be in a very good position, because when the music stops, the only thing that's really going to matter is who has the actual physical metal. And this is not the only sign that there are cracks showing in the paper markets. We covered yesterday the soaring lease rates on physical silver bullion in London. So that is the cost to borrow physical metal. And it's the same story in gold. This is from Bloomberg, from a piece published, I think, 2 days ago, about how the cost to borrow gold is also soaring, and it's unprecedented. Usually this lease rate is around 0. Same thing with silver, is around 0. Now it's over 8%. Maybe it's even higher today. So this is certainly a situation that stackers should be aware of and be monitoring. Is there a short squeeze brewing in silver? Well, I can't say for sure, but certainly these moves in the lease rates for gold and silver and in this cost to borrow of the SLV are unprecedented. So something is afoot here, but leave me a comment down below to let me know what you think is going on. And if you enjoyed this video, make sure you check out the video that's popping up on your screen right now. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.